Hello everyone, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there and finding some nice stocks for you. All you have to do is just watching this video and decided if the following stock, the Beyond Meat, is something for your portfolio. You could double your portfolio and your money. So let's stick around and discuss it. Please be aware that everything I say here is just my opinion, as I'm not an investment advisor. As you can see, I'm just a monkey, but I love to analyze high growth stocks. So, I would really appreciate it if you would hit the subscribe button below and become part of the Monkey Stock Club family, so you will never miss a video again. So, let's get started. Get started. Beyond Meat. To have an idea if the Beyond Meat stock is in high growth investing opportunity, I used my high growth investing analysis. Within the 6 KPIs, as I mentioned in some videos before, we have the opportunity to get 0, 1, 2, or 3 points. In total, overall, you can achieve 18 points as an top scorer for the high growth investing strategy. So the first KPI, the enterprise value divided by the sales actual. So if you divided the enterprise value by the sales, you can get an important ratio for estimating the valuation of fast growing but still loss-making technology companies. So if we divided the 10 billion US dollar market capitalization minus the cash plus the debit of Beyond Meat stock divided by the revenue of 400 million, we got 26. So 0 points, as we are not in the range of the 0.4 HGI-Score. So the next one, the cross margin, we have 35%, 0 points, as we are not in the range of the point of HGI-Score. So everything below 50% got 0 point. So to calculate the cross margin, we use the sales minus the direct cost divided by the sales. And the cross margin provides us a good indicator for the profitability of the business model, and the higher the percentage, the more money a company has available for other activities like sales, marketing, etc. So unfortunately 0 points. If we go to the next KPI, the Rule of 40 score, 115%, 3 points, as we are above 50%. So this KPI, the Rule of 40, is a simple key figure for assessing the efficiency of a company growth and also the quality of its business model. So the ratio is calculated as the sum of sales growth and the free cash flow margin. So the higher the value is, the better the business model is, as I mentioned before. So everything above 40 could be something interesting and attractive for us. So overall, if we using the sales growth within the last 12 months, very nice development, 142% plus the free cash flow margin minus 27%. We came up with as a lump sum 115%, and as I mentioned, our first 3 points within the high growth investing analysis. So the next one, the sales growth trailing 12 months, we've got 142 I also screenshotted the development within the last 4 years from 2016 to 2019. Quite nice revenue development, always increasing. We had a huge increase from 2017 to 2019. And if we are comparing the current sales within the last 12 months, we came up with 142%. So 3 points, very nice. As well as the earnings, as we can see here, we have an EPS within the last 4 years of a minus value. The EPS TTM currently minus 0.08. So, and the debit ratio is calculated by dividing the sum of the current and non-current liabilities by equity. So the last quarterly figures are used for this calculation, and this figure can provides us or let's say indicates a possible risk for debit. So the debit 64 million US dollar in the last quarter, divided by the equity of 989 within the last quarter. So we got 0.16, so below 0.5, as you can see here below. So 3 points, very nice. And last but not least, the last KPI within the high growth investing analysis, the PEG within the last 12 months. So the PEG is one of the most important key figures for the assessment of already profitable growth stocks. So it calculates the ratio of PE, so the price per earnings, and the profit growth. So if this ratio is between 0 and 1, this indicates an undervaluation of a stock. So as Peter Lunch already mentioned, if he sees the PE is equal the profit growth, so we would talk about 1, it's quite a good opportunity and good time to invest in this high growth stock. So, and what we've got for Beyond Meat, we have 662 for the PE TTM. As you can see here in screenshot where we are here, trading PE 662 divided by the profit growth of a huge profit growth of 637%, and so we came up with round about 1. So if we would be below 1 and above 0, we would get 3 points. Unfortunately, we have double digit, the 4 at the end. So just 2 points. Nevertheless, a good sign for the Beyond Meat stock. We have a huge profit growth. And yeah, that is why I would like to take a look into the fair value of Peter Lunch. So Peter Lunch, as I mentioned, says that if the EPS, or let's say the price per earnings are equal to the profit growth, we have 1. Then it could be a good opportunity to invest, as the price is in fair value. So, and here we are. As I mentioned before, 637 profit growth. We've got an estimation of 0.59 EPS for 2021. So the let's say, price development within the next fiscal year, 2021, could be huge from the fair value perspective of Peter Lunch or by Peter Lunch. So if we multiply the 0.59 with the current estimated profit growth, then we would came up to a fair price of 376. Currently, we have a closing price of 165. So this could be a great opportunity for us to invest in Beyond Meat. So yeah, that's it. As I mentioned here, you can see out of 18 we achieved 11. Not in highly top scored stock, but nevertheless, from my point of view, but that's just my opinion, as I mentioned, a good opportunity to invest. Yeah, and please feel free to hit the subscribe button below, as I mentioned. I would really appreciate it. You would help me to grows my community as I started last week. I will always keep you updated, and in return to that, I will show you quite good investment opportunities. So take care and goodbye.